I was staring at the anomaly on my screen when I realized I was witnessing something that shouldn't exist. Thursday, December 5th, 2025, 3:47 a.m. Eastern Time. The moment I discovered the digital fingerprint of what would become the most consequential force in precious metals markets since the Hunt brothers attempted to corner silver in 1980. Hidden within seemingly normal trading flows was a systematic accumulation program so massive and sophisticated that it was reshaping global silver pricing while remaining completely invisible to retail investors, financial media, and even most institutional participants. The pattern emerged from my proprietary order flow analysis system as I tracked unusual block trades across multiple exchanges and jurisdictions. Every time silver prices approached critical support levels around 58.59 per ounce, enormous buy orders materialized with surgical precision, absorbing all available selling pressure and establishing price floors that held despite repeated testing by billion-dollar hedge funds and algorithmic trading systems designed to exploit weakness. These weren't random institutional purchases or predictable algorithmic responses to technical indicators. The orders displayed characteristics that immediately separated them from normal market activity: perfect timing that suggested either extraordinary luck or access to non-public information, enormous size that required institutional-grade capital, and complete indifference to short-term volatility that would terrify conventional investors. Someone with virtually unlimited resources was methodically accumulating silver with patience and precision that indicated long-term strategic planning rather than opportunistic speculation. I began tracking the pattern systematically after 3 consecutive sessions where mysterious buying prevented natural price corrections from developing into broader sell-offs. The timing was too perfect to be coincidental, the execution too sophisticated to be retail-driven, and the persistence too disciplined to be emotional. This was institutional money operating according to a predetermined plan that viewed silver not as a trading opportunity, but as a strategic asset requiring immediate accumulation regardless of short-term price movements or market sentiment. The scale became apparent as I aggregated transaction data across trading venues in London, New York, Hong Kong, and Zurich. Between December 1st and December 18th, approximately $650 million in silver had been purchased through a complex network of intermediaries, offshore entities, and prime brokerages that obscured the ultimate buyer's identity while executing what appeared to be the largest precious metals accumulation program in modern financial history. $650 million. At an average purchase price of $61 per ounce, that represented approximately 10.6 million ounces of physical silver, equivalent to the entire annual production of a major mining operation like First Majestic or Hecla Mining, or roughly 1.3% of total global mine supply. But unlike mining production that entered markets gradually throughout the year, this accumulation had occurred within 18 days, creating concentrated demand pressure that traditional supply-demand analysis couldn't explain or predict. The buying pattern revealed extraordinary sophistication that suggested involvement by quantitative specialists with advanced market intelligence or sovereign entities with access to geopolitical information unavailable to conventional market participants. The orders consistently materialized during periods of thin liquidity when smaller capital amounts could achieve maximum price impact, appeared during Asian overnight sessions when Western institutional attention was minimal, and were structured to avoid triggering large position reporting requirements that would have revealed the buyer's identity to regulatory authorities. Most revealing was the buyer's complete immunity to normal market psychology and fundamental news flow. When silver dropped $4 in a single session following hawkish Federal Reserve commentary that sent precious metals investors fleeing to cash, retail holders panicked and liquidated positions to avoid further losses. When commercial banks coordinated massive short-selling campaigns designed to test technical support levels, hedge funds typically joined the selling to protect their capital. But the mystery buyer treated every decline as a purchasing opportunity, absorbing selling pressure with mechanical precision that suggested either unlimited capital resources or insider knowledge of factors that made current prices irrelevant to their investment thesis. I realized that whoever orchestrated this accumulation program possessed information or analytical capabilities that weren't available to traditional market participants. They weren't reacting to silver's price movements, they were controlling them. Every attempted sell-off was met with buying that prevented significant declines, creating an artificial price floor that gradually shifted higher as the accumulation continued, establishing new equilibrium levels that other traders began accepting as legitimate market dynamics. The identity of this mysterious buyer became my primary investigative focus, as I recognized that understanding their motives could provide crucial insight into where silver prices were headed and what fundamental shifts might be occurring in global commodity markets that weren't yet visible to conventional analysis. The sheer scale of the operation eliminated most potential candidates through simple mathematical constraints. Individual billionaires rarely allocated such massive percentages of their net worth to single commodity positions. Traditional hedge funds couldn't risk investor capital on such concentrated bets without violating diversification mandates, and conventional commodity trading firms lacked the capital resources to sustain multi-hundred-million-dollar accumulation programs without external financing partnerships. The systematic buying pattern pointed toward three categories of institutions with sufficient resources, strategic motivation, and operational capabilities for such an extraordinary undertaking: sovereign wealth funds implementing national resource diversification strategies as part of long-term economic planning, multinational technology corporations securing critical manufacturing materials to prevent supply chain disruptions, or central banking institutions hedging against currency debasement through precious metals accumulation that supplemented their traditional gold reserves. Sovereign wealth funds represented the most logical explanation given the enormous scale, strategic patience, and operational sophistication demonstrated by the buying program. The Norway Government Pension Fund Global, managing over $1.4 trillion in assets derived from North Sea oil revenues, had recently modified their investment mandate to include strategic commodities as protection against inflation and monetary instability that threatened their long-term purchasing power objectives. Norwegian fund managers had publicly discussed concerns about fiat currency debasement and expressed interest in real asset exposure that could maintain value during periods of aggressive monetary expansion by major central banks. The China Investment Corporation, with assets exceeding $1.2 trillion, possessed both the capital base and strategic motivation to accumulate silver as part of their comprehensive Belt and Road infrastructure development planning, which required massive quantities of industrial metals for solar panel manufacturing, telecommunications equipment, and advanced electronics production. Chinese economic planners operated with multi-decade time horizons that made current silver prices essentially irrelevant, compared to ensuring adequate material supplies for domestic industrial development projected to continue for generations. The Abu Dhabi Investment Authority had been systematically diversifying away from petroleum-dependent investments as part of their post-oil economic transition strategy that recognized the finite nature of hydrocarbon reserves and the global shift toward renewable energy systems. Their sovereign investment mandate specifically included accumulating strategic resources that would retain value during the worldwide energy transformation, making silver an obvious target given its essential role in photovoltaic systems, electric vehicle infrastructure, and advanced manufacturing technologies that would define economic competitiveness in coming decades. The Saudi Public Investment Fund, managing approximately $700 billion in assets, was implementing Vision 2030 economic diversification initiatives that emphasized technological development and domestic industrial capability building to reduce dependence on oil exports. Silver accumulation would directly support their manufacturing development goals, while providing portfolio diversification away from hydrocarbon revenues that were becoming increasingly volatile due to global energy transition trends and climate policy developments. Technology companies provided equally compelling explanations for the mysterious accumulation, particularly given timing that coincided with major technological cycles requiring unprecedented amounts of silver for next-generation manufacturing processes. Samsung's massive transition towards solid-state battery production required enormous quantities of silver for manufacturing operations that couldn't tolerate supply interruptions or price volatility, potentially justifying forward purchasing strategies that secured long-term supply agreements at fixed prices. Apple's supply chain management philosophy had evolved toward vertical integration of critical components and strategic stockpiling of essential materials to ensure production continuity for devices requiring precise specifications with zero tolerance for material substitutions. The company's cash reserves exceeded $190 billion, making a $650 million silver investment entirely manageable while providing insurance against supply disruptions that could affect iPhone, iPad, MacBook, and future product development. Tesla's approach to raw materials procurement consistently emphasized long-term supply security over short-term cost optimization, reflecting Elon Musk's willingness to make bold strategic investments that others considered risky but which often proved prescient. Tesla's solar panel production, Powerwall energy storage systems, and electric vehicle manufacturing all required substantial silver inputs, making massive accumulation logical if internal analysis indicated that silver shortages could constrain their aggressive growth trajectory. Microsoft's rapidly expanding hardware operations, including Surface devices, Xbox gaming systems, Azure cloud computing infrastructure, and emerging augmented reality platforms, required increasing amounts of silver for electromagnetic shielding, high-performance circuit boards, and advanced computing applications. The company's market capitalization exceeding $3 trillion made large commodity investments feasible as supply chain risk management strategies. The central banking hypothesis seemed less probable, but couldn't be eliminated given recent shifts in monetary policy coordination and reserve management strategies. The People's Bank of China had been steadily diversifying foreign exchange reserves away from dollar-denominated assets, substantially increasing gold holdings while exploring other precious metals that could serve similar monetary functions. Silver's dual role as both monetary metal and industrial commodity made it attractive for reserves diversification because it provided currency hedging while supporting strategic resource security objectives. As I investigated deeper into trading patterns and execution methodologies, additional clues emerged about the buyer's extraordinary sophistication and institutional resources. The accumulation wasn't random or opportunistic. It followed precise mathematical algorithms that optimized for stealth accumulation while maximizing position size within predetermined risk parameters. Orders were structured to avoid creating obvious market impact that would alert competitors or invite unwanted regulatory scrutiny from commodity futures trading commissions. The timing of purchases correlated with global news developments and supply chain events in ways that suggested access to intelligence about silver supply disruptions before they became public knowledge. Buying activity consistently accelerated before announcements of mining labor strikes, refinery maintenance shutdowns, and industrial demand increases that weren't visible in published economic data until weeks later, indicating either extraordinary analytical capabilities or access to non-public information sources. The operational security surrounding the purchases was remarkable in its complexity and effectiveness. No single intermediary or prime brokerage handled transactions exceeding $50 million, keeping individual relationships below thresholds that would trigger enhanced due diligence procedures or suspicious activity reporting requirements. Trades were executed through dozens of different financial institutions across multiple jurisdictions, creating an intricate web of transactions that would require sophisticated financial intelligence capabilities to trace back to the ultimate beneficial owner. The geographic distribution of trading activity suggested coordination between entities operating in the United States, European Union, and Asia-Pacific regions, pointing toward either a multinational corporation with global operations and centralized treasury management or a sovereign entity with diplomatic resources facilitating cross-border financial operations without triggering standard regulatory oversight mechanisms. The most revealing evidence came from analyzing market responses to attempted price manipulation by traditional precious metals, short sellers, and momentum traders. Every time major investment banks or commodity hedge funds initiated coordinated selling campaigns designed to trigger algorithmic stop-loss orders and create downward price momentum, the mystery buyer's response was immediate, overwhelming, and strategically sophisticated. They consistently absorbed artificial selling pressure while simultaneously increasing their accumulation rate, transforming attempted market manipulation into enhanced accumulation opportunities at more favorable average prices. This response pattern indicated real-time market intelligence capabilities and sufficient capital reserves to overwhelm any selling pressure that traditional market participants could generate, no matter how well coordinated or heavily capitalized. The buyer wasn't simply defending their existing investment, they were using other investors' fear and selling pressure as mechanisms to accelerate their strategic accumulation program while improving their average cost basis. The strategic implications became increasingly clear as I mapped the buying pattern against global silver supply and demand fundamentals that most market participants seemed to be ignoring or underestimating. The mystery buyer wasn't speculating on silver's price appreciation based on technical analysis or momentum investing. They were positioning for supply shortages that their analytical capabilities apparently indicated were inevitable given current industrial demand trends and mining production constraints. Their $650 million accumulation represented approximately 1.3% of annual global silver production. But the impact on freely traded market supplies was far greater because most mining output was already committed through long-term industrial supply contracts, government strategic reserve purchases, and investment demand from exchange-traded funds. The buyer was competing for the relatively small percentage of production that traded in spot markets, creating artificial scarcity that forced prices higher while expanding their strategic position at each successive price level. By mid-December 2025, the mystery buyer's influence on silver markets had become undeniable, even as their identity remained completely secret, despite intensive investigation by financial intelligence services, commodity research firms, and precious metals analysts worldwide. The artificial price floor they had established around 62 to 64 per ounce was holding firm despite repeated testing by short sellers who assumed that such strong support levels must eventually collapse under sufficient selling pressure. Instead, every attempted breakdown was met with buying that not only defended the support level, but frequently pushed prices higher, creating psychological dynamics that gradually shifted overall market sentiment from bearish pessimism through neutral consolidation toward increasingly bullish optimism. Traders who had been betting against silver found themselves repeatedly stopped out of losing positions, while momentum-following algorithms began interpreting the persistent buying as confirmation that long positions were more likely to be profitable than short positions. The buyer's presence was fundamentally reshaping how institutional participants approached silver trading strategies and risk management. Hedge funds that traditionally shorted precious metals as part of sector rotation strategies found their models failing as artificial support levels consistently held firm. Commodity trading advisors were forced to modify algorithmic strategies to account for persistent buying pressure that made traditional technical analysis patterns unreliable indicators of future price direction. Even sophisticated retail investors began recognizing that silver's price action had become unusually stable on the downside, leading to increased buying interest from momentum-following strategies and systematic trend-following approaches that interpreted the pattern as evidence of strong underlying fundamentals supporting higher prices. The most significant secondary impact was on institutional investors, who recognized that an entity capable of deploying $650 million systematically was accumulating silver aggressively based on analysis that supported much higher future valuations. If sophisticated capital with access to superior information and analytical resources had identified compelling value at current price levels, it suggested that independent analysis by other institutions might reach similar conclusions. This recognition triggered substantial copycat buying from pension funds, university endowments, insurance companies, and family offices that preferred following such large, obviously sophisticated buyers rather than conducting extensive independent commodity research. The multiplier effect amplified the mystery buyers' direct market influence far beyond their actual purchases, as their $650 million accumulation program attracted additional institutional buying estimated at $300,000 to $400 million from investors who reasoned that copying such systematic, large-scale accumulation was less risky than ignoring it. The combined impact on silver markets approached $1 billion in new institutional demand that wouldn't have existed without the mystery buyers' initial strategic positioning, demonstrating how concentrated, patient capital could create self-reinforcing market dynamics that attracted additional investment and established new price equilibrium levels that became accepted as legitimate market fundamentals. As 2025 drew toward its close, the identity of the secret buyer remained unknown despite extensive investigation by government agencies, financial institutions, and private intelligence services with sophisticated tracking capabilities. Their accumulation program had successfully established a durable price floor for silver while positioning them to benefit enormously from supply shortages, demand increases, or monetary developments that their analytical framework had apparently anticipated. The pattern of their recent operations suggested the primary accumulation phase was nearing completion, with buying activity becoming less frequent but maintaining the same overwhelming response to any significant price weakness that threatened their established support levels. The buyer had apparently achieved their target position size and was transitioning from active accumulation toward position maintenance, prepared to defend their investment against manipulation attempts while waiting for whatever catalyst they expected to drive silver prices substantially higher. The $650 million silver accumulation would be studied as one of the most successful commodity investment programs in financial history, not because of ultimate returns, which remained unknown, but because of its demonstration that sophisticated capital applied with strategic intelligence could control precious metals markets through systematic buying that overwhelmed traditional supply and demand dynamics. Whoever the mystery buyer was, they had fundamentally altered silver market structure in ways that would persist long after their accumulation program ended, proving that sufficient capital applied with patience could establish artificial price floors that became genuine market realities, creating self-reinforcing cycles that attracted additional buying and established new equilibrium pricing levels. The secret buyer had held the line when conventional analysis suggested silver should decline, revealing both the fragility of precious metals pricing mechanisms and the extraordinary influence that patient, well-capitalized investors could exert on commodity markets that appeared too large to manipulate. Their success would inspire similar strategies by other sophisticated investors, while establishing precedent for how concentrated capital could reshape commodity markets through systematic accumulation programs that created new pricing paradigms rather than simply responding to existing market conditions.